You open an investing app for the first time and close it 4 minutes later without buying anything. Not because you don't have the money, because you don't understand a single term on the screen, ticker, expense ratio, bid-ask spread, and buying something you don't understand feels riskier than doing nothing at all. This is where almost everyone starts. Here's exactly how to move past it. Step 1. Separate saving from investing before you do anything else. Before a single dollar goes into the market, you need an emergency fund, 3 to 6 months of essential expenses sitting in a high-yield savings account, not invested. This isn't overly cautious advice. It's the thing that prevents you from having to sell investments at a loss when your car breaks down or you lose a paycheck. If you don't have this yet, build it first. It sounds like a delay. It's actually the foundation. The market can lose 20 in a bad year, and you never want to be forced to sell during exactly that year because you had no other cash available. Step 2. Understand the 4 accounts most beginners actually need. A 401k or 403b, if your employer offers one, is usually the first place to invest, especially if there's an employer match. A match is free money. If your employer matches 50 up to 6 of your salary, contributing at least that 6 is an immediate, guaranteed 50 return before the market does anything at all. Nothing else on this list beats that. A Roth IRA is typically the second stop. You contribute after-tax money, but it grows completely tax-free, and qualified withdrawals in retirement owe nothing to the IRS. The 2026 contribution limit is $7,500 if you're under 50, though income limits apply at higher earnings. A traditional IRA works similarly, but contributions may be tax-deductible now, with withdrawals taxed as income later. Generally more useful if you expect to be in a lower tax bracket in retirement than you are today. A taxable brokerage account has no special tax treatment and no contribution limits, making it useful once you've maxed out the tax advantage accounts above, or if you want access to the money before retirement age without penalties. For someone starting from zero, the order is usually employer match first, then Roth IRA, then back to maxing the 401k, then a taxable account, though your specific tax situation can change this order. Step 3. Understand what you're actually buying. A stock is a small ownership share in a single company. Buying individual stocks means your outcome depends entirely on that one company's performance, which is why most beginner-focused advice steers away from picking individual stocks early on. An index fund pools money from thousands of investors to buy a broad slice of the market at once. An S&P 500 index fund, for example, holds pieces of roughly 500 of the largest U.S. companies simultaneously. You're not betting on any single company. You're betting on the market's overall long-term growth. An ETF exchange-traded fund functions similarly to an index fund, but trades throughout the day like a stock. For most beginners, the practical difference between a low-cost index fund and a similar ETF is small enough not to matter much. The expense ratio is the annual fee of fund charges, expressed as a percentage. A fund with a 0.03 expense ratio charges 3 a year for every 10,000 invested. A fund charging 1 charges 100 a year for the same amount, a gap that compounds significantly over decades. This single number is one of the most important things to check before buying any fund. Step 4. Pick a broad market index fund as your foundation. For someone with no financial background, a total U.S. stock market index fund or an S&P 500 index fund is the most commonly recommended starting point. Broad diversification, low fees, and a long historical track record, though past performance never guarantees future results. Look specifically for expense ratios under 0.10. Several major providers offer funds in this range, tracking the same or similar indexes, so there's rarely a reason to pay significantly more for comparable exposure. You don't need to pick individual stocks, time the market, or research companies to start. One low-cost, broad index fund can serve as the entire foundation of a portfolio for years, with more complexity added only as you learn more and if you choose to. Step 5. Automate a contribution, no matter how small. Set up an automatic transfer into your investing account on the same day each month, right after payday, before you have a chance to spend it elsewhere. $50 a month is a legitimate starting point. The habit matters more than the amount at this stage. Dollar cost averaging, investing a fixed amount on a regular schedule regardless of whether prices are up or down, removes the impossible task of trying to time the market. Some months you'll buy at a high point, some at a low point. Over years, this averages out and removes the emotional decision-making that causes most beginner investors to buy high and sell low. Step 6. Understand volatility before you experience it. The market will drop. Not might. Will at some point, likely more than once during your investing lifetime. Since 1950, The S&P 500 has experienced a decline of 10 or more roughly once a year on average, and declines of 20 or more a bear market periodically throughout most decades. Knowing this in advance changes how you react when it happens. A portfolio dropping 15 in a bad month isn't a sign something went wrong. It's the market doing what it has always done. The investors who lose money aren't usually the ones who experience a drop. They're the ones who sell during it, converting a temporary paper loss into a permanent real one. Step 7. Avoid the mistakes that hurt beginners most. Checking your portfolio daily tends to increase anxiety without adding useful information. A fund's 10-year performance is what matters, not its performance this afternoon. Many long-term investors check quarterly or even less often, specifically to avoid emotional decision-making driven by short-term noise. Chasing whatever performed best last year is a common and costly mistake. Yesterday's top-performing sector or stock has no reliable tendency to be tomorrow's, and jumping between hot investments usually means buying after a price has already risen and selling after it's already fallen. High-fee actively managed funds, which try to beat the market through stock picking, statistically underperform low-cost index funds over long periods more often than not, according to decades of independent research. S&P Spiva reports being one widely cited source. This doesn't mean active management never works. It means the odds and the fees involved tilt against it for most individual investors. Step 8. Increase your contribution rate over time, not your risk. As your income grows, increase the percentage you invest rather than your spending. A raise is an easy moment to redirect the increase toward your investment accounts before your lifestyle expands to absorb it. Resist the urge to add complexity as your balance grows just because it feels like the next level. A simple, low-cost, broadly diversified portfolio, contributed to consistently over decades, has historically outperformed far more complicated strategies for the vast majority of individual investors. Complexity is not the same thing as sophistication, and it often just means more fees and more room for mistakes. Step 9. Know when to actually seek professional advice. A fee-only fiduciary financial advisor, someone legally obligated to act in your best interest, paid a flat fee rather than a commission on products they sell you, becomes genuinely useful once your situation has real complexity. A mix of account types, a business, significant assets, or major decisions like buying a home or navigating an inheritance. For someone just starting with no financial background and a straightforward paycheck, the steps above are often sufficient for years before that complexity arrives. Don't let the absence of an advisor stop you from starting. Don't assume you'll never need one either. The core rule underneath every step here: investing successfully with no background was never about knowing more than everyone else. It was about consistently doing a few boring, well-understood things. Low fees, broad diversification, automatic contributions, and staying invested through the drops for far longer than feels necessary. Somewhere right now, someone is opening an investing app for the first time, closing it 4 minutes later without buying anything, unsure where to even begin. The information they need was never complicated. It was just never explained clearly. Now it has been. The next step is the same one that matters most. The first automatic transfer, scheduled today.